Hi everyone, and thanks for joining us today. I'm Cheryl Jansen, Director of Global Marketing for Sophion. Today's webinar is Financial Metrics to Drive Strategic Portfolio Performance. This webinar explores the typical portfolio and project valuation metrics with respect to what those metrics specifically indicate and the decision-making behaviors they drive. Based on the number of people on the call, this is clearly a topic that people are keen to learn about. Our presenter today is Michael Delaney, Innovation Management Consultant for Sophion. Mike advises global corporations on next-generation methodology to develop and execute robust innovation programs. With extensive experience in new product development, specifically in the automotive and alternative energy industries, and he is a certified new product development professional. Mike, thanks for being with us today. I'll turn the session over to you.
Okay, thank you, Cheryl, and thank you for joining us today. The genesis of this webinar is really based on my work with different companies. And the real question that we want to ask and maybe resolve today is, are you, as innovation managers, asking the right questions of your teams to support good decisions around investment prioritization? Now, while most all companies forecast the financial impact of their innovation investments, project or platform or R&D investments with financial numbers, the specific metrics that they are using to drive these prioritizations do influence the outcome of the portfolio, and that's not always obvious. So although sometimes it's very intended that we want to focus with a particular metric, say on something like profitability or on gross revenue, et cetera, sometimes the metrics that are being used are going to drive an unintended outcome. So the discussion today is really an exploration around some of the classic project and portfolio prioritization metrics, a little bit of a deep dive into what those metrics specifically indicate, and then the decision-making behaviors that they would drive. Hopefully at the end of the hour, we can ask ourselves, given that the most successful portfolios are guided by a focused innovation strategy, which metrics should your organization be using to prioritize and measure investment performance? So my general approach is going to be in 3 steps. Right? Step 1 is first translate corporate strategy, typically something written down in a PowerPoint slide or such, into specific innovation portfolios and their specific objectives. I really see that as a foundational bit to this approach. Step 2 would then be to identify appropriate financial metrics to forecast, prioritize, and eventually measure your performance against. And then step 3 is really to augment those financial forecasts with strategic qualifiers, because as we'll see, finances don't always drive the best behaviors. Now, there's one foundational assumption, in fact, it's quite a big assumption, that this whole method is just going to have to be based on, is that the investments being prioritized by an appropriate metric will actually deliver on that metric. And for everybody who's in the innovation space knows that is not a given by any means. So to suggest that you prioritize your portfolio based on top revenue potential, it does not necessarily mean that you will deliver all of that revenue. So there's obviously an assumption being made. So let's walk through each of these steps and sort of build those layers to our method. The first step, translating corporate strategy into innovation portfolios and objectives. And this is sort of a variant on a trend an approach that you may see through classic portfolio management literature, the idea of balancing a portfolio that is an enterprise-wide portfolio across different strategic arenas. The way I've represented it here is I have a company, an enterprise-wide portfolio, and this company is a relatively large company represented by the green box in the background. And they've decided that as an organization, given their size and maybe their maturity in the markets they play, the most appropriate innovation strategy is a balanced strategy. They're going to play into different arenas with different approaches. And they have one primary objective. That is $1 billion in revenue from new products launched over the last 3 years. Now, our job here is to translate that relatively high-level corporate strategy into more specific objectives for each of the business units because, they, as I mentioned before, they may not play in their industries the same way. To the left in the blue box, I have our first business unit. That's the industrial unit. And based on their position in their market, they take the general innovation strategy of being a fast follower. And as we can see, their financial objective put in front of them is about half of the total revenue ask of the entire enterprise. They're signing up for an increase in $500 million in revenue for new products over the last 3 years. Now, what's nice for Business Unit A is they actually contain just one portfolio of investment opportunities or projects. So that one-to-one relationship is actually a very nice thing to have. It provides clarity. So the innovation strategy for Portfolio A is that of its parent business unit, the industrial business unit, and it's going to adopt the same strategy of being a fast follower. And what we've driven then down to is what should the most appropriate prioritization metric be, and they're deciding that we are going to rank our investment opportunities, our projects, by stabilized revenue over time. Because of this fast follower strategy, that is the appropriate metric for them to deliver on their objectives. Moving to the center, I have a different business, Business Unit B, or home goods.